But when we come to India, the ownership of shares is very concentrated. Importance of volumes and delivery volumes. Now, what is essentially volumes? It is basically the number of shares traded or the number of contracts traded for the stock. Now, the volumes gives you an identification of how much of activity which is happening in the stock. Now, a change in volume gives you an indication of what is the market liquidity, what is the market activity. So it is just like a demand supply phenomena, wherein if you look at prices going up with higher volumes indicates there is more demand for the stock. In the same way, prices going down with high volumes indicates there are a lot more people wanting to sell. So number of shares traded in comparison with the previous volumes of the last few days, last few weeks, gives you an indication of the activity, the liquidity, and the sentiment of the demand and supply for the stock. Now, why is it more important to look at volumes? Generally, price should ideally be more than enough, right? Prices going up indicates the trend is up. But when we come to Indian markets, it becomes a lot more important to look at volumes. Now, globally, when I speak to my peers in other, say, very developed markets, they don't look at volumes as much because it's a very well diversified ownership. But when we come to India, the ownership of shares is very concentrated. For example, the whole Indian market cap, say out of 100 shares, 45 to 50 shares are with the promoters. Another 20% to 25% is with foreign institutional investors. So that makes it 70. Then you have another 10 to 15% with domestic institutional investors. That makes it closer to 85 to 90 in a lot of cases. So you have 50% with promoters, another 35% with institutions. So what happens is essentially the actual tradable float, which is more active, is only 10 to 15%. So that makes it very important to look at volumes because the company's market cap could be 10,000 crores, but the float available would only be 1,000 crores at times. So when there is somebody buying a lot of volumes with a price uptick, it gives you a much higher confirmation in Indian markets. And then we go into mid caps and small caps, it becomes all the more important. So that's the reason we give a lot of importance to volumes along with price action. The price volume matrix, the very simple way to understand price and volume action. These are the four things which we are looking out for. A rising price with rising volumes is an indication of positive momentum. A falling price with high volumes is a confirmation of negative momentum on the downside. And so basically, good volumes in the direction of the trend is a confirmation. Now, if a price rises with low volumes, it is generally a lack of demand. So that is a little bit of a negative in most cases. Now, price fall with low volumes, the last one. In this case, it could be negative because the prices are falling. But if it is in an uptrend and then the fall happens on low volumes, it can also be an indication that the trend is still alive. But the most important thing to look in this matrix is where price rises with high volumes is a strong confirmation. Price falls with high volumes, that's a strong confirmation on the downside. Adding to this matrix is a matrix which I follow, which is where I look out for some unusual price volume patterns which generally give you huge uptrends or downtrends. So the classic one is a price fall of 8 to 10% with 8 to 10x the volumes. Now the volumes could be just the previous day. Now this happens rarely when prices fall with such volumes, because if there is something wrong known to me and you and everyone under the sun, the stock price will be at a lower circuit. If you know there has been a huge terrible announcement which has very bad implications, none of us would be buying, right? So, but when a price falls with very huge volumes, it implies only the smarter people or only the people who understand the implications are selling and the world is buying. So whenever we see a price fall of 8 to 10% with 8 to 10x volumes, do not go and buy, just run away. Now the opposite of it is very interesting. A price rise of 8 to 10% with 8 to 10x volumes. Now this indicates there is a possibility of a huge demand coming in for the stock. Many a times, this could be a start of a trend if it coincides with a technical analysis chart pattern or a resistance breakout. Now, the only thing to note is at times there are huge volumes on bull deals. Now, that is something which is to be avoided. There are some bull deals happening which are already known. a change of promoter hands, they do not qualify for a price volume breakout. Now let us look at some examples of the additional price volume breakout which I look at. So the 8 to 10% move and 8 to 10x volumes. Now the best example for this is to look at a company which is the largest in India, the most traded one, Reliance Industries. Now this is a stock which was sideways from 2010-11 all the way till 2017, almost 6-8 years of zero return. Then the price breaks out about that price point of 520 to 560. Now look at that day out here on the candle. It's a huge candle, 8 to 10%. The volumes are 10x. Now to expect a 8 to 10x volume surge in a large cap is very rare. Now what happened after that? The stock went up from 550 all the way to 1000 over the next 6 to 12 months. And that was also the start of a trend for Reliance Industries. And over the last 5 years, 3 years, 1 year, the stock has been an outperformer from 2017. So that was the time where the first day Jio plans got launched, but price action confirmed it really huge. We started realizing the value of Jio because we are looking at these videos thanks to such huge penetration of Jio across India. So this was the start of a trend. Now the trend was very clear in terms of, like I said, somebody smart is buying on that day, somebody understands the implication of Jio. And that was the game-changing point for Reliance Industries. So the price action makes you just get into it. You don't need to be a visionary. Now, another example out here is Tata Consumer Products. Many years, the same price point creating a problem. Price breaks out, a 10% uptick, a new 3-year, 5-year high with 10x volumes. What happens after that? The stock does a good 50 to 60% move in a really small period of time, and then it continued to outperform. Take another example of a sleeping company, a MNC company, Abbott India. Now this is right in 2018. Now this was a period of time where the whole market was in a downtrend. The broader markets were in a downtrend. Small caps and mid caps had fallen. Suddenly out of nowhere, this company, which was also in a downtrend, makes a huge 10%, 15% move in a single day. Volume jump up 10 to 15x. What happens? Starts a new trend. And by end of it, the stock goes from 5,000 to 8,000 and then much higher over a period of time. So when you see such price volumes with a technical analysis chart pattern breakouts, which we looked at, a breakout combined with huge volume breakouts can be a huge opportunity. It could be start of a much bigger trend than you can imagine. Now, the same way it can be used on the other side, which is where huge fall with huge volumes. Now, this does not happen as easily. So let us take an example and you'll understand. So this is a chart for Diwan Housing Finance Limited. The stock had seen a huge uptrend before this. Then in 2018, on a single day, the stock fell by 30-40%. The volumes were up 10x. So the first instinct for you is to buy a stock because it is down 30%. You think it is an opportunity, it's a discount sale. But essentially, that is the worst trap you can get into because there is never a single cockroach in the kitchen. And when you see such huge volumes, just run away. The first instinct would be to buy. But the reality is, if you have guts, you have to actually go short. Now that is difficult for most people to sell a stock down 20-30%. But that is the trade, it works. So what you can do is, not everyone can be gutsy. Whenever you see something like this, just run away. Because there is a very high possibility the stock may remain in a downtrend for a really long time. And you don't want to get back into the stock till the time the previous day's highs are not crossed. For example, the stock is trading at 800, the stock falls to 600. You don't want to be looking at the stock till the time it crosses 800. Or at some point of time, after 2-3 years, sees a 10x volume jump up with price action. Out here, in this case, Diwan Housing Finance fell from all the way down from 800. Over the next few years, the stock finally got delisted. And there were another time in 2019, end of 2019, where it saw similarly large volumes and it continued. Let us take another example, a great company which has been a huge compounding machine for Indian investors, Divi's Labs. So this stock had a huge run up till 2016-17. Then one fine day, there is an FD alert. The stock falls by 20% or more with 10 to 15x volumes. Now, what happens in this case? Now, this is a known company. Diwan Housing is a known company. So you get tempted to buy because the stock has fallen. But the fact is, If it falls more than 10% with 10x volumes, there is something wrong. If everyone knew it, what is wrong about it and what are the implications, nobody would buy, right? It would be on a lower circuit, continue on a lower circuit, right? So in this case, the stock fell from 1150 levels to 800. It had a tough period of time for the next few years, next couple of years, went all the way down to sub 500 levels. Now, this case, the stock went down, then finally consolidated. The stock again saw 10x volume jump up. And then that was the point of time you got an entry at 800 and then a new trend started. Now, what is interesting in this case is during that period of time, there were many other companies which went through a similar fall in the pharma space. Something like Sun Pharma, Dr. Reddy's, Lupin. For example, Lupin was 2000 rupees. Today it is 700 rupees. It has still not recovered. Very similar examples are for companies like Financial Technologies. Then some more examples like Crompton Consumer, wherein eventually the promoters had to change hands. A lot of these companies do not come back. DB's was an example of a comeback, but we've seen 95% of the companies which see such falls actually go through huge price corrections and never come back. So remember, 10% downtick, 10x volumes, do not buy, just run away. Now, the last point is importance of delivery volumes. Now, what is delivery volume in a simple way? For example, the number of shares traded are 1 lakh. The deliverable quantity is only 10,000 shares. It implies 90,000 shares were traded intraday and squared off. Now, this may be normal for a large cap company because there is a lot of trading volumes. There is a derivative arbitrage. So there is cash and futures. There are a lot of people trading it. But an unknown small cap company only trading 10% delivery volumes is generally an indication of speculation, and at times it could be circular trading. So my criteria is very simple. For a known company, 10% delivery volumes is fine. But for an unknown company, single digit delivery volumes is a big red signal. That could imply the stock is manipulated at times. Now, also the second signal is when there are such low delivery volumes, it could also indicate a lot of speculation going on that day. So ideally what I want is when I see a breakout, the delivery volumes should not be single digit. If the delivery volumes for the stock is 80% generally, a 40% delivery volume is okay because the volumes are up 5x. So the net delivery volumes will still be much higher. But suddenly if the stock trades 8% delivery volumes, that's a red flag for me. It could be speculative in nature and may not follow up. In that case, there will be a fade off. Even if the trend has to go up, it will fade off for the next few sessions. So this is a recent example for a company called Gland Pharma, which has gone through a huge downtrend. Suddenly one day the stock went up on very large volumes. For the next few sessions, as you see, it just fades off. And then maybe you can again relook at it. Do not try to chase a stock with 8% delivery volumes. Another example, Lux Industries. The stock saw only 6% delivery volumes. Huge volumes, almost a 20-30x volume change, but the delivery volumes are only 6%. Did not see a huge follow-up. For the next few sessions, it faded off. Then also it has been a laborious move in the last 2-3 sessions. So this is where it can help you in terms of short-term trading. So in your breakouts, a very simple criteria is single digit delivery volumes is a red flag. Now the reason we want to look at it is, what happens is, there are many stocks which are manipulated. So for example, there are companies which go up like this example in front of you. The stock keeps on going on upper circuit. Still the delivery volumes are low. Also, many of these stocks would have gone up multiple times. Many of these stocks would actually have you getting SMSs, WhatsApps telling you how great this company is, but you've never heard about it. So these are classical pump and dump. Another cotton company recently was there, which went up this way. The stock has fallen on 4 lower circuits in the last 4 sessions. So when you see unknown companies with single digit delivery volumes, just run away. And they might be a case of pump and dump. So a lot of these companies, whenever we've seen, are companies which are going to fall maybe 60-80% also at times. So where do you track delivery volumes? Now, the reason also to look at delivery volumes is in a breakout, if the delivery volumes are high, like the normal traded shares are 1 lakh, suddenly the general delivery volumes are say 80%. So you have 80,000 shares of delivery. Now consider the stock trades 5x volumes, right? And the delivery volumes are only 40%. That still implies 2 lakh shares got delivered instead of 80,000. That is still a 2.5 times of change in delivery volumes, which is still good, right? But if that happens, that 5 lakh shares volumes and only 10% delivery, it implies the actual deliverable volumes were lower than the previous day, right? So a confirmation in terms of delivery volumes helps you understand that a lot of people who bought today took the shares home. Why do we say took the shares home? Because the simple mathematical calculation is if the prices are going higher, the buyer has picked up the prices and he's taking the delivery home and he's creating the demand. So a large change in delivery volumes is also what we look out for in a confirmation. You can go to the NSE India website. You can see delivery volumes at end of the day after 4:30. It also updates at a lag of 1.5 hours during the day as well to give you an indication of delivery volumes. It's not necessary to see during the day, but it is now available. This used to be not available a few years back. Same way on BSE India, you can see it. And a lot of apps and broking apps also give you this data. To sum it up, why is volumes important? The first part, India is a very, very concentrated market. So that is the reason the importance of volumes is much higher in India. The second part is a volume gives you a confirmation of demand and supply. So a price rise with huge volumes in a breakout is a good indication. Third, we look at delivery volumes because delivery volumes indicates how much of the quantity actually was delivered. So a single digit delivery volume in an unknown company is a red flag. And if it happens in stocks which have gone multiple circuits, be careful. And finally, I always end it with 10% fall with 10x volumes. Do not get tempted, stay away. So that is how we look at volumes and the importance of delivery volumes.